Hey folks, Dan Frio here, the rate update. Today is June 25th, 2021. What we're going to talk about next is one of the biggest questions I get on a daily basis. Is now a good time to buy? Don't go away, I got some expert advice for you. Okay, so I get the skepticism. You guys are saying, hey Dan, you're in the mortgage business. You make money when people get mortgages or when people buy homes. I get it. But let's go on to the experts on Wall Street to see what they're saying about the housing market and getting the facts from them. And then we'll be right back.
Every day, it seems, we get another piece of extraordinary economic news. And every day it's presented as something dangerous, something negative. Whoa, something that will cause real problems down the road. Rather than greeting good news with wonder or maybe even jubilation, we respond with fear because we've forgotten what a rapidly expanding economy looks like. Maybe some people are too young. That includes days like today, where the Dow slipped 71 points, S&P ticked down 0.11%, NASDAQ gained 0.13%. So I'm going to give you the classic example, okay? Lead story in the digital edition of the Wall Street Journal when I woke up today. U.S. existing home prices hit record high in May. All right, now this piece, like so many others, reads like Exhibit A in the case against Jay Powell, our valiant Fed chairman, who's trying to hold off on raising rates in order to boost job growth even as demand is constrained by supply, which makes overall sales look weak. High prices, weak sales, recipe for disaster? Now, wait 1 second. First, Powell recognizes that a booming housing market is actually a good thing, not a bad thing. This is an industry that gives people good-paying jobs, even if they don't have a computer science degree from Stanford. Plus, as I never get tired of telling you, housing punches above its weight in the economy. So you'd much rather have a rising housing market, which is about 10% of the economy, than a faltering housing market. Yet when you read these headlines about home prices hitting new records, they're almost always written like an arbinger of bad times, like the economy must be overheating because of housing. So is this industry the enemy when it's good? Something that must be tamed, lest we end up with Weimar Republic-style hyperinflation, this time with wheelbarrows full of greenbacks and not Deutschmarks? I think this is a good time to give you some context beyond the headlines. Because in the context, what's happening in the housing market is actually healthy, not toxic. And I say that knowing that KB Homes, which just reported, disappointed some who are looking for better numbers. For a clear head of what's going on, I'm turning to Doug Yearley, the CEO of Toll Brothers, not just because he runs a giant home builder, but because I've known him for years. And when things aren't good, he's always been forthcoming about it, as has his previous boss, Bob Toll. Not that long ago, Doug threw an important and incredibly enlightening analyst day, you can read it online, to explain why the housing market's growth might actually be longer term than you think, rather than a cyclical boom and bust kind of growth that we've all come to expect. Listen to this. Over the last decade, 6 million less houses were built. 6 million less houses were built than in the previous 4 decades, going back to the 1970s. He goes on. It's possible that housing is just beginning to recover, given that we have many more people in this country than when we were building more homes, end quote. Yearly's conclusion, quote, it's going to take a long time for this pent-up demand to be satisfied. We think it's going to take years before we ever get back to anything close to the equilibrium that we had seen in a bunch of the prior decades. That's right. We used to build 2 million homes a year when we had half the population. We're doing half that with twice the population. Now, if you think that Yearly's just talking this book, and I get that, I am sure the skeptics out there doing that, why don't we do this? Why don't we go to Stuart Miller? He's the straight-shooting executive chairman of Lennar, another exec I have known since he was a young man, and I helped manage his brilliant father's finances when I was at Goldman Sachs. Miller tells us, quote, new home construction cannot ramp quickly enough to fill the void of the production deficit that has persisted over the past decade, end quote. He continues, quote, while some question whether that deficit is 1 million homes or 5.5 million homes, the bottom line is that supply is short and is likely to remain that way for some time to come, end quote. That's right. We literally can't build new homes fast enough to meet the demand. Now, let's say, okay, let's do what everybody tells me has to happen. If Jay Powell raises interest rates, that's not going to create more homes. Even it might push down housing prices by, of course, destroying demand. Then again, it could also make housing less affordable by driving up mortgage rates. I don't know, Hobson's choice to make. But a lot of that demand might be indestructible. If we just give it some time, it'll be good. It'll be a good thing. As Hole's Doug Yearly lays out, quote, there are 73 million millennials who are now entering their 30s and they're buying homes, end quote. Now, this key ineluctable demographic detail always gets left out of stories about the red-hot housing market, and that's just plain misleading to do so, because it means that demand may be, and here's a word no one ever wants to use with housing, but I'm going to use it. The demand may be secular, not cyclical. The Fed can try to slam the brakes on the economy by raising interest rates, but millennials have been stuck living in their parents' basements for years. After a decade getting over the financial crisis, they've finally got the capital to buy their own homes. Why would we want to put a stop to them buying their own homes and all the good things that happen to the economy when housing hums because of the multiplier effect of housing? Speaking of the financial crisis, though, we all remember the last time we had a red-hot housing market, 2006, right before the worst economic meltdown since the Great Depression. And yeah, that red-hot housing market absolutely led to the financial crisis. It was the epicenter. But 2021 is not 2006. The problem back then was that many people were trading homes like they trade stocks on Robinhood, except with even more leverage. Our regulators were asleep at the wheel. Rather than trying to enforce lending standards, the Federal Reserve decided to cool down the housing market by raising interest rates 17 times in a row in rapid succession. Now, how'd that work out? Well, great. Yeah, it cooled the housing market. It crushed everything. I don't want to repeat the mistakes that led to the financial crisis. No, I got a show. I got to speak about this stuff. By the end of the last housing boom, we saw people buying houses with no money down, at a fraction of what the loan to value. Oh, the worst stuff was like they're buying them down, buying them, and then getting the down payment from a home equity loan, sometimes with no documentation needed, sometimes with wildly overvalued numbers. At the time, the home builders told us all of these things were happening, including, especially Toll. The company even tried to limit speculative buying at the cost of lower sales because it saw what was happening. But this time, none of that stuff is going on. Lending standards are much more stringent. There are no more no-doc loans, no more ninja loans. It's actually very hard to get a mortgage, even though rates are low. Again, I think that points to constrained but secular growth for the first time in the history of the U.S. housing market. Finally, these Saturnine articles about how the housing market's too hot always seem to leave out the most salient part of the story, COVID-19. This stuff gets covered like the economy's still normal, but there's nothing normal about this situation. People have become untethered from their white-collar jobs, from the desks that they used to slave at. So now they can work remotely. They're fleeing the cities to work in places like Boise. Yes, Boise, Idaho. In many ways, Boise is the perfect microcosm for this event. Ever since May of last year, there's been a massive exodus of people moving from the West Coast to Idaho, creating one of the hottest real estate markets in the country, all documented in the Toll Analyst Day. Same thing's been happening in Austin, Texas, which was already on fire even before the pandemic. It's got the hottest housing market in this country, which could also be the world. We're also seeing insane levels of demand from several markets in Florida. This is COVID-19 and some tax situations. Could all these markets be cooled down by the Fed? Absolutely. But what the heck would that accomplish? When home prices are on fire, we build more houses, which creates more jobs all over the country. When home prices fall, those jobs vanish. Why do so many reporters act like hurting the economy is a good thing? Unlike the lead up to the Great Recession, home buyers are actually solvent right now with excellent credit, strong stock portfolios. The home builders, they're in good shape. The banks are strong. Sometimes good news is good news. If you try to overthink it, you're going to miss out on some huge moves. Bottom line, the next time you read a story about how we should be alarmed that the economy is doing so well, think about the alternative. Would you rather see a headline like housing prices plummet as market weakens from higher rates? Or pile to home builders drop dead? Call me crazy, but I think that sounds like the wrong way to go.
Okay, so the facts are the facts, unfortunately. You guys are still going to say, well, Wall Street capitalizes on this stuff too with the mortgages and so forth. Yep, a lot of people do. But the numbers don't lie. There's a pent-up demand. We're coming off a year of basically people just stuck in their houses and not doing anything. And the data just is what the data is. So being that is what it is, if I can help you guys get pre-approved, to buy a house, or if you already own a house and you're looking to refinance, or just don't know your options in regards to a forbearance, please check us out. The best way to reach us is to go to our website. But first, I'd like you to check out my YouTube channel. You can find that right here at the Rate Update with Dan Frio. There's over 900 videos, and we just peaked over 14,000 subscribers. Actually, I think we just hit 14 too, so we're adding about 100 a day, thanks to you guys. But if you want to check out the website and reach out to us for assistance, please go to therateupdate.com. This will be changing next week. We have a ton of added features to it. You can click here right now to apply, and this will take you right to the website, and you can apply online. The cool thing about this is you can basically do everything in the palm of your hand or at your desktop, and you can follow your loan throughout the entire mortgage process. If you'd rather call us, just click or scroll down below and you'll see our 800 number, 844-775-LOAN. That's 844-775-5626. Or scroll up a little bit, and here's a calendar. You can schedule a consultation with me. You can pick a 15, 30, or 60-minute consultation. You just click in there. You look and see the time of day, the time and day that I have available. Click through here, click it. You'll get an alert, I'll get an alert, and I will see you that time on that day. So that's it for today, guys. Have a great weekend. I'll come back to the mortgage rate update on Monday, but today I wanted to kind of debunk everybody's naysaying about the housing market. So take care. God bless, guys. I'll see you next week.